3 stocks I'm bullish in July. If you ask me right now which stocks in the US market are most worth holding, my answer is clear. Apple, Intel, and SanDisk. These 3 names represent 3 entirely different ways to make money. Pricing power, a turnaround story, and a cyclical earnings boom. And they share one common thread. Over the next 3 to 12 months, the density of catalysts is extremely high, and the uptrend logic is so clear it requires no guesswork. Let's see them one by one. 1. Apple. Pricing power, the most elegant way to make money. Start with a simple question. If a company raises the price of its product by $200 and customers keep lining up to buy it, what does that tell you? It tells you this company possesses the rarest asset in the modern era, pricing power. And that is exactly what Apple is doing right now. On July 14th, Morgan Stanley analyst Eric Woodring published a note titled, "Higher Prices Begets Higher Earnings." His core call? A $200 price increase across the entire iPhone 18 lineup is becoming increasingly likely. A $200 hike, that would be the largest across-the-board price increase in iPhone history. You might ask, won't that scare consumers away? Morgan Stanley's data gives the answer. iPhone's historical price elasticity is just 0.2 to 0.5. In plain English, a 10% price increase would only cause a 2% to 5% drop in unit shipments. In other words, for every extra dollar Apple charges, almost all of it flows straight to revenue growth. Why can Apple do this? Because its users are not price sensitive. The Apple ecosystem, its brand equity, and customer loyalty form a moat that no other manufacturer can cross. In June, Apple already raised prices on MacBooks and iPads, with CEO Tim Cook calling the increases unavoidable. Yet after those hikes, there was no meaningful change in Mac or iPad lead times. The same story is about to play out on the iPhone. The immediate trigger for the price hike is surging memory chip costs. The AI infrastructure boom has tightened global DRAM and NAND supply dramatically. Morgan Stanley estimates that Apple's average DRAM procurement costs will rise roughly 370% between fiscal 2025 and 2027, while NAND costs will jump 280% over the same period. Costs go up, and Apple doesn't just pass them along, it actually makes extra profit in the process. What's the bottom line? Morgan Stanley projects that this pricing strategy could add 2% to 4% to third quarter earnings per share and roughly 1% to full year fiscal 2027 earnings. On the same day, Citi raised its Apple price target from $315 to $365. Morgan Stanley maintained its $360 target. Where is Apple trading now? Around $314. $360 implies about 15% upside, and that's a conservative estimate. Now look at the timeline. July 30th earnings, September iPhone 18 launch, and the public beta of the new AI-powered Siri. 3 catalysts compressed into less than 3 months. Apple is also in talks with Silicon Valley startup Prism ML to bring AI model compression technology to the iPhone, shrinking large models from 54 gigabytes down to just 4 gigabytes so they can run directly on device. Apple is quietly embedding AI into the hundreds of millions of devices people use every day, setting the stage for a massive replacement cycle. So far in 2026, Apple shares are up 16%, making it the best performer among the Magnificent Seven. While the market keeps debating which AI stock will double, Apple has been quietly delivering the simplest, most reliable story. The math of price hikes is deterministic. Sure, KeyBank just downgraded Apple to underweight with a $250 target, citing risks of demand destruction, carrier subsidy cuts, and slower services growth. Those risks are real, but think about this. KeyBank's concerns point to structural pressures over the next 3 years. Our time horizon is only 3 months. In that window, Apple faces a dense cluster of catalysts, not a story that takes 3 years to play out. The direction is clear. 2. Intel, the most aggressive price target on Wall Street from the most unexpected source. If Apple is steady growth, then Intel is the wildest bet out there. What has this company been through over the past few years? Losing market share to AMD, getting lapped by TSMC, and being left for dead by the market. But just when everyone had written it off, HSBC did something that made the entire street sit up. HSBC analyst Frank Lee doubled his Intel price target from $100 to $200. $200. That's the highest target on Wall Street for Intel right now. HSBC reiterated its buy rating. What's the justification? Based on all the information I've gathered, the thesis rests on two core manufacturing drivers. First, surging demand for data center server CPUs. HSBC raised its 2026 server CPU shipment growth forecast from 20% to 25%, and for 2027 from 20% to 30%, citing strong AI server demand over the next 2 years. Server CPUs are the key driver of Intel's earnings recovery. Second, the Foundry business is now being valued again. HSBC previously excluded Intel's Foundry operations from its valuation due to uncertainty over external customers. But that's changed. Customer engagements are growing, and design commitments could materialize starting in the second half of 2026. Intel is now working on Foundry deals with Apple, Alphabet, NVIDIA, Microsoft, and Amazon. HSBC believes Intel's Foundry business is now too big to ignore. Intel's EMIB packaging technology could also benefit as chipmakers look for alternatives to competitors' limited foundry capacity. Intel shares are already up 168% year-to-date in 2026. The stock pulled back from $140 at the end of June to around $110 in early July, but the fundamental narrative hasn't cracked. If anything, it's strengthening. Intel will report Q2 earnings on July 23rd. Progress on external foundry revenue and 18A process yields will be the first real test of this turnaround story. When a top-tier investment bank doubles its price target to $200, it's not betting on maybe. It's betting on what's already happening. Intel's story isn't concept hype. It's about Xeon processors in short supply, terafab foundry orders being placed, and 18A yields ramping up. From $110 to $200, that's nearly double sitting right there. 3. SanDisk, down 30%, yet analysts are calling for $3,100. This last one may offer the biggest upside of all. SanDisk, the king of NAND flash memory. Over the past 3 weeks, this stock has been hammered, down 28.3% from its all-time high of $2,335 on June 25th. On July 14th alone, it tumbled 12.6%, the fifth double-digit percentage drop in the last 3 weeks. The stock now sits around $1,757. What caused the crash? A broad semiconductor sell-off, panic triggered by SK Hynix's plunge, and violent swings in the memory sector. But Wall Street's smartest money is not just unfazed, they're doubling down. Evercore ISI analyst Amit Daryanani made a jaw-dropping move, raising his SanDisk price target from $1,400 to $3,100. $3,100. That implies nearly 85% upside from the July 14th close. Daryanani believes investors are, quote, underestimating the sustainability of SanDisk's earnings and free cash flow over the next several years. He raised his revenue and EPS estimates, pointing to 5 new business model agreements that should generate at least $62 billion in committed revenue over the coming years. Even more critical is the supply-demand picture. SanDisk's newly signed business model packs are driving a new memory paradigm where supply-demand imbalances reinforce pricing power. With memory market imbalances expected to persist through 2027, SanDisk's pricing muscle is set to stay strong. This isn't a normal cycle. It's an AI-driven, structural, multi-year memory supercycle. Wedbush analyst Matthew Bryson put it bluntly. The memory market is still in very good shape. NAND flash in particular faces severe capacity constraints, with clean room space remaining the primary bottleneck. Until new clean room capacity comes online, memory supply is unlikely to meet demand. Citi reiterated its $2,500 target, and Bernstein recently raised its target from $1,700 to $3,000. Among 29 analysts covering SanDisk, 23 are bullish, 5 neutral, and only 1 bearish. From $1,757 to $3,100, 85% upside, written in black and white. Why these 3? Have you noticed what these 3 stocks have in common? First, they all have top-tier institutional backing. Morgan Stanley and Citi are behind Apple. HSBC is putting the highest street target on Intel. Evercore is calling for an 85% rally in SanDisk. Wall Street's smartest capital is converging on these three names. Second, they all have clearly defined catalysts. Apple has its July 30th earnings and September iPhone launch. Intel has its July 23rd earnings and Foundry order momentum. SanDisk has a structural supply-demand imbalance that runs through 2027. Third, they've all experienced meaningful pullbacks. Apple has pulled back slightly from its $323 high. Intel has corrected from $140 to around $110. SanDisk has plunged from $2,335 to $1,757. A pullback is not a risk, it's an opportunity. Retail is panicking. Institutions are accumulating. This is the classic signal of smart money buying into fear. Apple's pricing arithmetic, Intel's Foundry narrative, SanDisk's memory cycle. Three sectors, three different theses, all pointing in the same direction, up. With Intel earnings on July 23rd, Apple earnings on July 30th, the iPhone launch in September, and sustained memory tightness, the catalyst density over the next 3 months is too high to ignore. Of course, risks remain. KeyBank is bearish on Apple. The street consensus on Intel is only a hold. SanDisk has shown extreme short-term volatility. Nobody can predict short-term price moves. But when it comes to directional probability over the next 3 months, the upward trend of these three stocks is among the clearest I've seen in recent memory. Have you noticed that every major wealth redistribution in history has started with a tiny crack that seemed insignificant at the time? After the dot-com bubble burst in 2000, no one wanted to touch tech stocks. But what happened to those who bought Amazon and Apple? During the depths of the 2008 financial crisis, no one wanted to touch banks or quality assets. But what happened to those who bought? During the COVID crash in 2020, everyone thought the world was ending. But what happened to those who bought? Every time, every single time, it's the same script. Fear spreads, retail sells, institutions buy. Then the cycle turns, wealth changes hands, and those who hesitated stay on the shore watching other people's ships sail away. Today's Apple, Intel, and SanDisk, they're playing out the exact same movie. Apple is quietly building strength on the certainty of price hikes. Intel is turning the corner at a pivotal moment in its Foundry transformation. SanDisk is being hammered into a Goldilocks zone at the bottom of the memory cycle. Three stocks, three sectors, one signal. Smart money is moving in, panic money is moving out. 3 months from now, when the iPhone 18 price hike is fully digested by the market, when Intel's 18A yield data surprises to the upside, and when the memory supply-demand gap widens again, you'll look back at today's prices and wish you had done something. Some doors only open once. While they're open, you always think you can wait a little longer. Once they close, you realize that wasn't just an ordinary door. Intel earnings on July 23rd. Apple earnings on July 30th. The iPhone launch in September, and the memory supercycle. The catalysts are lined up. All that's missing is your decision. Opportunity favors the prepared mind, but wealth only belongs to those who dare to act. Cut through the noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.